Good evening and welcome to this Friday edition of the Private Property Podcast. I'm your guest host, Ekow, and I'll be filling in for Zamantuanga Kumalo this evening. Tonight, we'll be talking all things insurance, and my guest with me tonight is Douglas Haig, who is the Managing Director of CIA Building Insurance Specialist. And as usual, please leave your comments below and Douglas will endeavor to respond to them. Douglas, thanks very much for joining us this evening. And before we get into the nitty-gritty of this show and the talking points of this show, I think it will be prudent if you could give us a brief introduction of your business and what it entails.
Hi, Ekow. Well, thank you very much for having me and welcome to all the listeners. It's good to be here and to share some of the insights into insurance, which I think often is a very misunderstood field. So just to give you a bit of background about CIA, we're a specialist building insurance underwriter. We've been going for around 20 years now. We're part of the worldwide Hanover Re Group, which is one of the largest reinsurance companies in the world. We cover over 750 billion rands worth of buildings here in South Africa, and probably pay on average about 40,000 claims a year. 6 branches across the country, and as I said, we really only insure buildings, so we're not concerned with cars or windscreens or cell phones or laptops. Our business is buildings, and that helps us understand the risk of buildings better, the risks they pose, and also when it comes to claims, how to rebuild them and put them back together quicker. And that's, I think, one of the edges that we bring to the market. And also our policies are really tailored to the building owner, be it sectional title or homeowners or commercial property owners.
Okay, so thanks, Douglas, for this. Tonight we'll be unpacking 4 things that new property buyers should know about building insurance. And to me, as a property investor, I know that insurance is a necessity in our everyday lives, right? And Douglas, I think the key question is, what is the difference between sectional title and private home insurance?
Okay, so that's a good starting point because it talks to the ownership of a building, okay? And if you think of sectional title development, the exterior of the building all forms part of the common property, okay? And and that's why you'll see sectional title developments, and they're very popular in South Africa. They all look the same, they have the same general layout, and they're usually painted the same color with the same type of roofs. The reason is that the ownership thereof all forms part of the common property, and in a similar way, the costs relating to that property, be it maintenance as well as insurance, then all form part of a single cost item and are shared not equally, but are shared between the unit owners as part of the body corporate. So what would happen is that the insurance for a body corporate would be taken out on one policy. So every unit owner wouldn't have their own building insurance policy. They would all form part and they would take out a single insurance policy that covers the entire development. The important thing and the good thing about insurance for sectional titles is that it's quite closely regulated. And there's actually legislation that specifies what must be covered by the body corporate. And the trustees can actually be held liable if they fail to insure a body corporate for those specific perils. On the other hand, you get private home insurance, and that's if you think about your normal house in a normal suburb, freestanding homes, there each owner has to take out his own insurance, okay? And each owner is responsible for the building himself, and he has to then take out his own insurance. And it's one that's it kind of crosses both legs is full title stands in a residential development. So some of these larger residential developments provide for full title stands. So each owner owns his own property, pays his own rates and taxes, and builds his own house according to his preference, but the security and the infrastructure is shared. And in that case, the owner would still take out a building insurance policy for his own building, but the homeowners association would take out an insurance policy to cover the walls and the roads and maybe the tennis courts and that type of thing.
Okay, so Douglas, now that we know the difference between sectional title insurance and private home insurance, as a seasoned property investor, I can tell you now that I always get blindsided, or most of the time get blindsided on what's supposed to be covered and what's not supposed to be covered. So could you please take us through what's supposed to be covered in building insurance, what's not supposed to be covered, and why?
Okay, so the easiest way to explain building insurance and what forms part of your building insurance house, and you turned it upside down and you shook it, gave it a good shake. Everything that's going to fall out of that house, that's going to be the contents. Okay, and that's you'll take out a separate contents insurance policy for that. But everything that stays stuck to your house, that will be insured as part of the building, and that forms part of your building insurance contract. So things like your stove, your swimming pool, your walls, your roof. If you install trellis doors, or even if you install blinds, often you'll have, especially the blinds that are screwed into the walls, shelving, kitchen cupboards, all of these things. If you had a lovely big built-in cupboards with desks and bookshelves and all of that, that would form part of the building. If, however, it was something that you could take with you when you move, that then is considered as contents. So I think now we've got this building, so what's covered? So generally, sudden and unforeseen damage to this building. So that would be things like a fire or a flood or a hailstorm, or unfortunately, as we now more and more see, is trucks or cars driving through people's lounge windows on a Sunday evening or on a Friday evening. So those are the type of things that building insurance is really designed to cover. And then there's also there's the main these key perils, and then you get also cover for things like a geyser and power surge and loss of rent. You know, if you're renting out your property, you would include loss of rent cover to cover you in the event that your house burned down and your tenant moved out, or you had to refund your tenant or something like that. So that's what is covered. What's not covered in terms of a building insurance policy, obviously, is things that are not attached to the building. And then, I mean, while I'm here, I might as well just touch on a few of the standard type of exclusions in a typical building insurance product. And it's really, I think if you understand the main categories of exclusion, then it becomes very easy to understand whether an event will be a claim or not. And I think the first point is a building insurance contract is not a maintenance contract. So it won't cover you for things that are supposed to be part of the maintenance. For example, your roof needs to get painted, the waterproofing needs to get resealed. If you don't do it, and after a number of years, your roof starts rusting or develops little holes in it, that won't form part of an insurance claim. However, if your roof is in good repair and it gets knocked by hailstones and it gets big dents that crack the paint, that would be covered. So damage that happens over time is also not. Also, you get items in your house that have a useful life. Think of your carpets. And, you know, I can picture them in my mind because many carpets, as you walk over them more and more and more, they just wear down, and after a while you've just got holes. And obviously a carpet like that wouldn't, replacing that carpet is an ownership expense. You have to, as a property owner, carry that cost, but you can't claim for that from your insurance. A third one that's also quite important and often misunderstood, but is an exclusion regarding defective workmanship. Okay, and the key here is that obviously building regulations have been enacted and they in law, and insurance policies are written on the basis that if you've built a building, you've complied with all the necessary laws and standards that one would expect. And so you do get cases where a builder or someone would take a chance or not build a thing correctly, not follow the instructions, use inferior materials, and that could cause damage. And that, unfortunately, is also not covered because the recourse in that situation is against the builder who took the chances. And why? It's a question we often get. But the problem with something that's not installed correctly, if it says you need to attach an aircon to the wall with these bolts, and you think, no, I'm going to nail it to the wall because I don't have these bolts or I don't believe it, or for whatever reason, and you go nail your air conditioner to the wall and it falls out tomorrow, we're going to say, but the instructions and the way you're supposed to install an air conditioner is like this, and you've definitely not done it, and that's caused it to fail. So it comes to that point of, if something's insurance events need to be unforeseen. You should not be able to predict when it's going to happen or that it even will happen. You should just know there's a possibility it might happen. But yeah.
Yeah. I'm so glad that you touched on the roof story, because I had an issue with my body corporate in one of the units that we owned, and it got rained on, and the body corporate, well, the managing agent then turned around to say that the roof is not covered. Only the ceiling inside the building is covered. And yes, I was baffled by that, but at least with this explanation, I now know why or where it comes from. Now, Douglas, tell me, what are the key things one should look for when insuring a home?
Okay, there's a few things, and I'll touch on just a few of them. But the first thing, I think, when insuring your home, and it's different between a body corporate unit, so a home in an estate or your own home, but you should always make sure that your unit is in, or your home is insured for the correct value. And the way building insurance is written, it's very different to car insurance. So building insurance is on a basis of new for old. So you have an old building, but if it burns down, we will pay to build a new building. Whereas if you think of your car insurance, you buy a new car today, you insure it, but if you crash it in 5 years, you only get, they don't pay for a new car for you, they pay the value of your old car. So the important thing with that is that means the building value that you use must be up to date with what the building cost today is. So if you built your home 5 years ago for R1 million, you wouldn't expect that you could rebuild it again today for that same million. You'd expect there's building inflation and things like that. So it's very important to insure it for the correct value, as if it burnt or as if it burnt down today. And just another thing that you must take into account is cost of demolition and cost of professionals, i.e. appointing a quantity surveyor and an architect, and also the cost of demolition. So that adds about, in our experience, it adds about 30% to a valuation. But one thing to remember with building insurance is that it's probably the cheapest insurance you can actually buy. It's, just to give an example, our average building cover, it's between 10 and 20 cents for 1,000 rands worth of cover. Now, if you compare that to car insurance, that's 25 times cheaper. So in building insurance, it's better to rather be overinsured than underinsured. The other things to look for, just quickly, is what is the characteristics of the building, and that should inform the type of cover that you take out. So if you have a thatch larper that's attached to your building, be careful to make sure that that's firstly disclosed to whichever insurer, and that they cover that, because you'll find differing approaches between insurers. One insurer will include it as part of the house, and they'll just mark it on the schedule to say, yes, it's a small LAPA, less than 10 square meters, so there's no additional charge. Other insurers will exclude it totally. Others will charge an extra premium or add some requirements. Another interesting one is dolomite. So you want to, if you're in a dolomite area, or if you've bought a property in a dolomite area, and the dolomite area, for example, around Johannesburg is quite wide. It's a large ring around, starting Centurion, going all the way south. If you've bought a property in a dolomite area, you need to check the subsidence cover that's provided, because there's also a differing approach. Some exclude it totally, others give full cover. So it's an important aspect to consider.
Okay, so yeah, so we are going to take a quick break, and we'll be back after this.
Thanks.
Welcome back to the Private Property Podcast. I'm Ekow, and this evening we are looking at the key things that you need to look for as a homeowner or a new homeowner or buyer about building insurance. Douglas, before we went on the break, we spoke about the things that you need to look for in order, or the key things that you need to look for in insuring your home. For me, as a property investor, I always go back to me being a property investor. So for me, as a property investor, I know that under insuring your property places me at a very serious financial risk. Now, can you please tell us what is under insurance clause? Why is it important, and what is the consequences of it?
Thanks, Ekow. Yes. So unfortunately, underinsurance it's not a nice thing. And when it happens, unfortunately, you only find out about it at the worst possible time. If you never have to claim, underinsurance will never be a problem. Unfortunately, it's when you claim that you find out you are underinsured, and then it creates significant problems. And I'll explain why. So if you're underinsuring, what you're doing is you're actually saying, say your building is worth R1 million, and you insure it for 500,000. What you're actually saying is you're only insuring half the building, or 50% of the building, and you're only paying 50% of the premium. And so the expectation, or the result, is that when you have a claim, only 50% of the claim will be honored. So that's really, another way to look at it is to say, well, if my building is worth R1 million, but I only insure it for 500,000, then I'm actually co-insuring it with the insurance company. The insurance company takes 50% of the risk, and I take 50% of the risk. And then when we have a claim, they pay 50% and I pay 50%. So it's really something that, due to the low cost of building insurance, you really need to avoid it. And the best way of avoiding it is making sure, if you a private home, make sure you've spoken to your broker. You can get an independent valuation done. You can speak to builders in your area, find out what the average cost. I mean, most insurers, like us, will have a buffer for underinsurance. We'll have we give up to 20% that we won't penalize you for that. But so that covers you for the most thing, but it's good to have a valuation done. For a body corporate, you're protected by law in that every 3 years, by law, the body corporate has to have a valuation, a proper professional valuation done, which then helps them make sure that the building is correctly insured. The other word for underinsurance and what you'll normally see in a policy is the average clause. So when we talk about average, what we're actually meaning is this problem of underinsurance.
Okay. So Douglas, I've got a question from Kofa Tokane, who says, okay, so building insurance covers sudden damages, not wear and tear. So I guess the question that he's trying to ask is, does building insurance cover only a part of damages, but not covering the wear and tear of your property?
Yes, exactly. And that's a very important thing. So things, wear and tear is not covered, unfortunately, because it's difficult. It's like, things that wear out over time, it's very difficult, like your engine in your car. It's very difficult to actually insure that in a way that, that makes economic sense. One of the things that in recent times that is a good example that we do provide wear and tear is on a geyser. So if you think of a geyser, the cylinder is a metal cylinder that has a lot of water, but over time, it will start rusting. And it takes a long time, maybe 5 to 7 years. And at some point, a rust breaks through and the water escapes. So that's a case of wear and tear that is actually covered. But for the rest of the building, it's generally not covered.
Okay. So what are some of the common causes of fire and floods in SA, and how can they be prevented?
Sure. So, we see a lot of fires. I think the most important thing, and I tell my friends and my family this, is that like we see fires every single day. There's a fire. Somewhere there's a fire. Someone's unit burns down. But the people that it happens to, it might only happen to you once in a lifetime. If you're a property owner, you might only ever have one. Hopefully you never have a fire at all. So you don't generally think about fire. And this is something that really, the message that I like to get across to people, you need to think about fire because they happen. And when they happen, they cause a lot of damage. And while you can insure your property, life damage and things like that can be very destructive. So the things that we see, and especially like now, you see there's a lot of load shedding going on. So a common one, people leave either a laptop or a hairdryer. They're busy hair drying, or they're plugged in, they're sitting on their bed, and there's a hairdryer or a laptop, and then they leave it. And they go out, and the power comes back on, no one's around, the hairdryer switches on, it gets very hot on a bed, and you have a fire. Leaving a laptop on is also one that we've seen. Some laptops can get extremely hot, especially if the fan gets blocked, and we've seen fires caused by that. We've seen, at school we were always taught, with a plug, never put too many plugs on one thing, and you always think, but trust me, the amount of fires that we have just because of that. Multi-plugs, and don't trust the multi-plug. Buy good quality ones. Be careful of the cheaper alternatives that feel flimsy, because again, a multi-plug, especially now, you take a heater that's pulling 2 kilowatts. I mean, that's a sizable load of energy there, and it's pulling it through this little flimsy thing, and it's got other stuff going off it. Most of our fires are caused by electrical things of that nature. Okay. I think floods, you can't do much with floods, unfortunately. If you live in a flood area, there are some preparations, but generally homes and things you shouldn't build in a flood area. That's the first thing. And there are regulations that cover that. And I think general water issues is just keeping, if your gutters are maintained and your roofs is maintained, that's generally okay. But there's some things that you just can't prevent, and that's where you have insurance. A tornado is the scariest thing. We saw them a few years ago. They caused chaos, turning over cars, ripping roofs of buildings. Those are the type of things that really scare me. And unfortunately, there's nothing you can do. I think the best thing you can do is get under your table. That's what people told us. One guy, he had his officers, and he just said he had his whole team under the boardroom table, waiting for the tornado to go through. So yeah.
Okay, so now that we know majority of the questions being answered, and we well educated and informed about insurance policies, tell me, what are the common reasons why, and which is something dear to my heart as an investor? Again, I go back, and probably for anyone that's about to invest in properties, what is the common reason why our insurance or claims get rejected?
Okay. So I think it differs for types of insurance, but for building insurance, it's definitely our top rejection reasons are wear and tear, or things that happen over time. And then the other one is defective workmanship. Those three are really, and we've talked about them previously, but just to recap, things that happen over time, you can't insure them. Insurance works on the principle that not everything will happen to everyone. It will only happen to some people. So for 90% of people, they'll never have a claim. And for 10% of people, they'll have massive claims. And so in that case, the things that happen gradually over time, those, if you had to insure them, you'd have to charge the full cost of the repair every month to everyone. And that would just make insurance unaffordable. So those are the key things. The defective workmanship is really one to watch out for. It's important that especially when you're buying a property, to make sure that the municipal plans are done. If you can, have a survey done. I mean, it's a big expense. Pay someone to look through the house, check the roof, check for sagging. It's actually a lot more common than we think. You see the tiles on the roof start sagging, and that's definitely an indication that the roof isn't strong enough to hold it. Or what will happen is people will go and put extra loads on, or they'll build additional walls or rooms and that type of thing. Be careful of that. It has to be done in terms of the national building regulations, not only for insurance, but just for legal purposes. A big one which we see is boundary walls. And this is unfortunately for body corporates and for private homes, is that boundary walls are often built too high and without sufficient support. And what happens there then is that children climbing on it, or just a little bit of water can push it over and cause a lot of damage and presents a very high risk of injury. The other thing I think is with exclusions, those are the three main ones. So if you remember those, you're pretty much fine. And a good policy should be clear on its exclusions. I just maybe want to talk about that as well. There's two ways of writing an insurance policy. The one way is to do it, or the most comprehensive way, is to do it on an all risk basis. So what the insurer then does is they say all the damage, any damage, is covered that happens to this building, except if we note it here. And they give you a list, and they actually write out every exclusion and every limit. So that gives you a list to work through, and that you know exactly. What's good about that way is that if the insurer hasn't written an exclusion, if they didn't think about some type of risk, or they thought that would never happen and they didn't write it in an exclusion, it would automatically be covered. The other way of writing a policy is to say you are covered for a fire, or you are covered for a hailstorm, or you are covered, and in that way you are specifying the risks that you're covered for. But and that's fine, that's good. But say now there was something happens to your building that wasn't written down, that wouldn't be covered. So it's important to look at that. The other thing with the exclusions is insurance is a promise. So the details of the promise, what you're getting, what you're actually buying, is all contained in the policy wording in the schedule. So it's really important to read it and to understand it, and ideally work through a broker that can explain it to you and help you. But really, as a property investor, especially, knowing and understanding insurance and making insurance work for you is a critical part of being successful.
Okay, and I've got another question here from Asian Ama, who says, suppose a house was insured for 1 million 5 years ago, and on the 6th year, the value increases from 1 million to 1.8 million. Will the insurance premium be reviewed in accordance with the new valuation? If so, how is this achieved from the insurer's side?
Yeah, so, well, the most important thing is, remember, the insurance value is not the market value. So the insurance value will keep track with building cost inflation. So it will be a lot more in line with general inflation in the country. So whereas the market value will go up and down like this. I mean, the market value can go up 30% 1 year, especially in a good area. And in bad areas, it will drop 1 year. So that's the most important thing, that the value that we talk about is insurance value. And the best way, or what we do, and most insurers do this, is that we increase your sum insured every year by inflation, and that then trickles through to an increase in your premium. But it smooths it out so that over time we keep track. The important thing is to get it right at the start. If you get it right at the start and you just follow the normal inflationary increases, you should be fine. Because that plus the 20% buffer really does cover most of it. It's the challenge comes in the market value. So now what happens is you go and you find a bargain. You're looking to invest in a property, and you're going into this fancy suburb, and you find this old house, and you reckon, geez, like, this is a bargain. It's R1 million in an area where most of the houses are insured or sell for 3 million. So let me buy this property. It's only R1 million. The problem there is you mustn't insure it for $1 million. You must insure it for what it would cost to rebuild it new and on that day in that area. So that's where, while you are buying a bargain from a market value point of view, from an insurance point of view, you need to insure it for the full building cost.
Okay, so there's one more question from Masehla Mokata. He says, if I am in a building of a sectional title act and the building is insured, does that mean that insurance is covered my unit as an owner, or should I also cover my unit against any damages?
No. So yes, yes and no. So your building, if you're a unit owner in a sectional title complex, your unit, the walls, the stove, the cupboards, all of the fixtures that are attached to the unit, that is covered by the body corporate. Okay. What's not covered is your TV, your fridge, your clothes, that type of thing. So, but it's important as a unit owner, you can request a copy of the policy. You can ask them, show me a copy of the policy. Who are we insured with? What is the policy wording? And that way you can understand what you're covered for. And if you're unhappy with it, the best way to then change insurer or to get more is to speak to the trustees. They're responsible, and they will usually work through a broker, an insurance broker, who's the guy or the person that really is there to give advice and tell you. But yes, just in a short summary, if you're a unit owner in a body corporate, the body corporate insures the building. So if there's a fire or an earthquake or a tornado that takes off the roof, the body corporate's insurance will respond to that.
Okay, good. So that's all we have time for this evening. Douglas, thank you very much for joining us. We'll leave it there. And of course, the conversation still continues with ST's program coming up this evening. And also, you can still continue with the conversation on the private property channel and my YouTube channel, Property Ask Ekow, which is a platform where we promote financial independence by blending money with meaning, profit with purpose, street smart with heart. Thank you very much, everyone, for watching this episode this evening. Until next time, bye-bye.
Okay. Good evening and welcome back to the First Time Homebuyer Show. I'm your host, SD Carson. And tonight we're joined with Nthato Raboshaka, and we'll be speaking about how you can pay off your mortgage in only 6 years. Yes, you heard me correctly. 6 years, not 20. Hi, Nthato, how are you?
Hi, SD. I'm well, thank you. How are you?
I'm well. It's so good to have you here. And I think I'd like to jump straight into it. So my first question is really just about you. Who is Nthato?
Well, Nthato, I guess my roots are based in Limpopo. Originally, we're from a small village called Skakeni. And then in the 80s, my parents moved to Shawelo in Soweto. And then when they got married, they then moved to the Val. That's where I grew up. So yeah, I think I stayed there majority of my life. I went to Wits to study chemical engineering. Then I worked as an engineer, and along the lines, I was doing property, which I started very, very early in my life, just due to my brother-in-law. He was into properties and a lot of businesses. Then I left South Africa to go to South Korea to study nuclear power plant engineering. And I came back and just pushed hard in the property businesses. I guess I saw that side, how they were going about it, doing so well. And there's a big market here, and I decided to go fully in.
Yeah, I totally agree. The property market is, and it keeps getting bigger and bigger. So maybe just share with us some of your insight on, I know you said you started with your brother-in-law. What was your specific journey into property?
Yeah, well, I guess before that, while I was still in high school, it started off with my brother-in-law, and that's where I learned a lot of things about property. He had properties in the townships, he had properties in the suburbs, and then I learned how to do the calculations, to do the math, to take the capital costs of it, how much it makes you, taxes involved, and the stark differences between properties in the township and in the suburbs. You then see that the same rules don't apply. And in the township, that's where one makes the most of money, and to check how much capital one can put in there. And with my first property, I went against my guard. I went straight to the suburbs, bought a nice townhouse, got a good tenant. And, and at the time, I thought I understood how things work. This is like where you were probably a decade ago. And now I went in and I lost so much money. And the property wasn't making as much money as I had hoped for, and the key being hope, because I was basing it on hope. Much as I understood a few things about property, but I didn't run the numbers well. How much are the taxes, the cash flow? Cash flow is very important when you're looking into properties. I was looking into return on investment only. It looked solid, but you know what? The biggest lesson I learned there was to cut my losses. After around 4 years with it, I sold it. I lost money, but it's fine because it was going down the drain. The levies were skyrocketing. The rates and taxes were killing me. The rent was just dwindling, if not standing, just stagnant. So at some point, one had to see that, is this working out for me? No, it's not. And afterwards, I went into the drawing board. I did the math. I did my calculation. I learned. I attended courses. I attended online classes. I went in. And yeah, then I started coming back, picking up myself. And I did it in different ways. I did it on my own. I do it investing with a couple of my friends. I have a property crowd funding group. So now it's diversified. I also looked into investing in property shares, which I hate. Investing in shares has nothing to do with property. Investing in a company that is listed and they do property, to me, that doesn't make you a property investor, because we have seen even now the stark difference between the market and the actual life happening on the ground. So even if property brings money, if the market says we are selling this stock, you're going to lose. And ultimately, if the company pulls a sign off, you're going to lose all your money. But the nice thing about property is that even if all else fails, you still have something to salvage and sell.
Exactly. And I think your story is so powerful because you were able to, like you said, pick yourself up and keep investing in property. And that brings me to my next question. So why property? I'm sure we could invest in so many other things. Why property per se?
Yeah, definitely. Well, I love brick and mortar. And one thing that I like about it is that at the end of the day, we all need a roof over our heads, irrespective of how the economy is, whether there's a pandemic, there's lockdown, people need a place to live. So when you look into property, the market has been there. It's been solid for decades. And I've invested so much of my life into it. I understand almost every aspect of it. And that's one of the most important things. Don't invest in something you don't know and something you don't understand. If you don't understand anything, well, don't be angry at yourself. Don't hold back. However, look out for people who have been here before, people who understand the game, people who will help you to go through things. Check books, read, study, enlighten yourself. But most importantly, either way, you're going to have to pay. You either pay a coach to put you in the right direction, as I've done with many of my clients, or you're going to pay the price of ignorance. And the latter is very much expensive.
Exactly. And I like what you said, because there's a term that I like to use, which we call experiential learning. You know, if you don't try, you might never know. And, you know, like you said, keep going to textbooks, having people help you figure this out. And even if we do all of this, even if we do experiential learning, and I'd like to say that experiential learning is when you learn from your own mistakes. So what were some of your obstacles, your first investment, or even that you're still making till today? Some of the obstacles and mistakes that you make.
True. Apart from the mistake that I made with my first property, and that it set me back. I mean, I took, I think, over 2 years just to stabilize. And that one really set me back because I was still very, very young. Then it was, I guess, getting into the market was a very, very big obstacle. You understand that with me, I value the entire value chain. I don't just want to own a property. As soon as I got my first property, I was asking myself, okay, but then if I own 2, 3, 4 more, or 5, even 10, who's cleaning these properties? Who's guarding them? Who's making money out of this? So I started a cleaning company to clean my properties. Now you understand that things are rolling a bit, even though it wasn't official, but it's only this year that we've said we are officiating things. But I knew as someone who cleans for this cost, this is how much profit I make. So you're looking into such things. Then also, what I then decided was to work as a property professional, commonly known as a real estate agent. It was very, very difficult to get into the game. Simply being that to get your first FFC, this is your license to I guess, sell houses, to do rentals, you need to do a 1-year internship. Getting that internship was very, very tough. Majority of people whom I was hoping to give me a foot in the door to help me to get in and start off were not willing to do so. And someone actually told me that, no, but you overqualified. You have a master's in nuclear engineering. Why are you selling houses? Why are you here? You're not supposed to be here. But they didn't see the bigger picture. The bigger picture was that one day I want to have my own. I have Ntato Realty now, and we are pushing, we're working hard, but there are a lot of obstacles that come along the way. Also, the matter of finance, raising funds is difficult for property because you have your own limitations. Apart from your salary, you may not have other forms of income. So if your salary allows you to buy properties up to 1 million, that's it, that's your ceiling. But you're ambitious, you want more. That's how we started the property crowdfunding group. It's doing well. We're doing buildings in townships. We are building nice, proper flats, you know. So basically, we're taking people out of a back room into your own bachelor pad with your own kitchen and your own bathroom at exactly the same costs. So there's a market for that, and it's doing very well. So those are some of the obstacles that we faced along the way. But as you can hear, for every obstacle, it presented an opportunity, and I'm grateful for that.
Exactly. With every obstacle comes a reward. And from what you just said, you started a cleaning business, because who's cleaning these properties? And so you become a part of the system. And I think a lot of people try to beat the system, but just become a part of it and learn how to alter it from the inside. And I see with all the small businesses that you have going on, you know, something on the side or your main projects, all of these benefit one another. They're all feeding each other. And that's how you continue to grow. Definitely. So I think that, yeah. And this brings me to my next question. So what made you want to pay it off in 6 years? 6 years is a short time.
It is. It's crazy, actually. It's quite an audacious move if one can think about it. But, once you understand how money works, once you understand how banks make money, once you understand how to keep the money that comes into your pocket, earning as much as it's important, but what's most important is how much of what you've earned can you keep for yourself after all these debit orders have come through and ravaged your account. And that's when I then looked into the concept of paying off in 6 years. And the nice thing about it is that we've proven the concept. We've proven it with a few couples that I've been preaching to, that, guys, this can be done. You are driving an X5, you live in a proper house, 3-bedroom, the 2-bath, 2-garage, the standard, I've made it, starter pack. But here you are. You don't know what your future holds for you. In 14 years' time, you may lose your job. In 20 years' time, you may not be working. I mean, you have some people who've started working when they were 30. You take a 20-year bond, you're going to pay it off when you are 50. Imagine, that's crazy. If it's 30 years, you're going to pay it off at 60 when you're going to retire. But most importantly, an example that I put forward is, it's a pandemic now. You have people losing their jobs that never even thought that COVID will come, there'll be a lockdown and you can't work anymore. Had you started the process of paying off your house as soon as you can, you're probably paying it now on the 14th year, you are losing your job. The bank will foreclose and they will take that house. Imagine paying 14 years just to lose your house, just at the brink of having it. That's when we're looking into the matter of interest, compound. How does it work? As much as owning property is a nice thing, it's a good thing to have as well, but paying it off, that's what's important, especially if it's your primary residence, because it's just a liability. It's sitting there, it's not giving you a single cent. You are paying rates and taxes, you're paying levies, you're paying water, you're paying electricity. So this thing is draining money out of your pocket. Anything that is draining money out of your pocket, you must plug it as soon as you can. That's why we're looking into paying it off in 6 years. But what's the practicality behind it? Because sometimes people stretch themselves. You afford a house of 1.5 million and you take up a bond of 1.5 million. For such a person, it may not be easy. Actually, it may be a bit practically impossible to pay it off in 6 years. But if you pay just an extra 10% into your bond, just a mere 10%, your bond term reduces from 20 years to 15 years. That's a huge saving. But for someone who's saying, I want to start investing into property now and I want to do it the right way, this message is for you. Because when you qualify for a house of R1 million and you know definitely that you can afford the 10,000 per month, our advice is that buy a house of 500,000. Pay that 10,000 that you would have paid either way. In 5 years' time, you're going to own that house. If you do that, the same cyclical process for the next 20 years, in 20 years' time, when we compare Mr. Sipo, who took out a bond for 20 years and paid it over, and we are comparing him with Ntato, who's paying off houses every 6 years, you find that after 20 years or 24 years, I now own 4 properties, which I fully own. If it so happens that within 10 years of us paying these bonds, we lose our jobs, I have a house that is fully paid. I can use it as security for other things. Most importantly, I will just lose my job. I won't lose my house. My kids will still have a shelter over their head. So those are some of the concepts we have to bring into people. But the most important one is a matter of compound interest. Albert Einstein says those who understand it earn it, and that's the banks. And those who do not understand it, it's the man on the street, that's you and me. They then pay it. Because when you take out a bond of R1 million, you're going to pay it back at 1.7 million, 2 million after 20 years. That's a lot of money that you've flushed into this house. But most importantly, it's how the interest is then factored in, because in the first 8 years, you are paying purely interest. Basically, if you sell your house after 5 years and you've been paying the minimum requirement, you'll find that you don't have any profit on it because you've been a glorified renter. But that's a topic for another day.
Exactly. And it's so true what you said. No one expected the pandemic to come immediately. So if we had been prepared for this, it would have been better. And you know what? During this pandemic, a lot of people have actually been able to, a simple thing as work from home. If we didn't have shelter, we wouldn't have been able to do that. People are starting small businesses inside their home. If we didn't have shelter, we couldn't do that. So I totally agree with you. And I love your energy, and I love how you speak so passionately about this. And it's clearly because you're educated on this topic. But what is it that keeps you motivated and drives you every day to keep going?
Yeah. Well, for me, I was raised by a single mother. My dad passed on very, very early in our lives, and she got into entrepreneurship because, you know, back in the days, you'd find that when someone gets married, you must sit at home and the husband takes care of the whole family. He was doing a very good job at it, but no one foresaw that he would pass on. Now, my mother had to venture into entrepreneurship. And one of the first things that I learned in business was she used to buy chocolates for 1,000 rands. After selling those chocolates, she had 6,000 rands. 6,000. So that's where you realize that, hey, entrepreneurship pays off, you know? If you invest your time in it, if you invest your effort into it, this is one of the best ways for one to actually make a living. But apart from that, I've been very serious about getting an education. I value education. I really love it. But to be honest, the day I die, I'm going to go to the grave with my master's degree from South Korea. I don't do anything for my children. You don't do anything for my family. So if I'm building these businesses, I'm building a legacy for them. They're going to have something to live off. They're going to have something to pass on to the next generation. So we are focusing on generational wealth. It's not about us. With us, unfortunately, we're born into this world the way it is, but it's our responsibility to ensure that whoever comes after us starts at a better level, starts at a better note.
Exactly. And with all the mistakes that we've made, whether it's journeying into property or investing in other things that you've made, is there anything that you would change?
I would change nothing at all. With what the losses that I've incurred, I've lost so much money, but you know what? Had I not lost anything, I wouldn't be here today. Chances are I would have not even taken property investing as seriously as I take it now, because now I look at it as a business. We focus on it. It's our business, and we are growing the team now. I mean, now it's just a two-man show, but the way that we are pushing in our businesses, the way that we are trying to expand and go forward, it's simply based on our background, what we've seen, what we've learned, you know, the hurts and everything that comes together, most especially the wins. You know, one of my favorite books, The Alchemist, while he was in the desert, he then found an oasis, and then there was water then. And the line that he mentions is, as you go through life struggles, at some point, you know, God, or how they say, the men upstairs, other people, they throw you a lifeline. You know, there's some small wins that you need to celebrate, and they then actually show you and help you to keep going forward, because you can see that there's light at the end of the tunnel. This can work, and it's doing very well.
Exactly. The small wins always manifest to something bigger. And I don't think we necessarily see it in the moment. But if you look back now, like you said, you wouldn't change anything, because it's just been so great. So just before we run to an ad break, Ntato, what are some, we always talk about obstacles and regrets. What are some things that you are really proud of? Decisions that you made that you are proud of?
Yeah, the decision that I'm proud of, one, is expanding the team. At first, I was a one-man show, and much as all income came to me, but I can't expand myself. I can only be, I'm finite. So I expanded the team and brought in a very, very qualified person who's doing very well, complement each other, and also diversifying, you understand? Because now I'm not only investing in property. We clean the properties. I do property investment. I'm a real estate agent. I do rentals, sales. So you find all these multiple income streams. When one is dry, the other one is giving you an income. So that's a huge balance that you've made. So I'm very happy about that one.
Yes, a lot of things we can't do by ourselves, you know. So I think what's also a good lesson to take from this is that, you know, find people in your circles or people that you've graduated with that can maybe help you start certain businesses where you can invest, whether it's property or whatever else it may be. So thank you so much. We're going to quickly run to an ad break. Please don't forget to comment and ask some questions for Ntato, and then we'll ask them at the end of the show. Stay tuned. welcome back to the First Time Homebuyer Show. As you know, we tuned in with Ntato, who paid off his mortgage in only 6 years. Just before the break, we spoke about why he did it, what motivated him to do it, and the obstacles that came in the way. And I think the burning question that we're about to ask is, Ntato, how do we do it as well?
Yeah, you need tons and tons of discipline to achieve that. One would have to sacrifice, especially in the lifestyle that one would want to live. We do understand the history of this country, where you had the marginalized people living in the townships, and the majority of us who actually make it to varsity and study and become professionals, now you want to move your family into the suburbs, which is a good thing. There's nothing wrong with that. But as you take that bold step and move to greater heights, also understand the dynamics that come with it, understand the financials of it, and just factor everything in. But what's most important is living beyond your means by far. Irrespective of your income, one of the quickest ways to have a shot at life and ensure that you increase your income streams, increase the quality of your life, is to just live beyond your means. And as I had mentioned before, all that you need to do is buy properties that are worth half of what you can afford. Just literally go for half. And for the majority of South Africans, that would go into sectional schemes, that would go into your flats, because you find that you just started working now and you can actually afford 5,000 a month, but you can find a flat that requires 2.5 a month. You buy that flat, you just put as much money as you can into it, put just double of what's required. It's just a simple formula. If you put double of it in 6 years' time, definitely it's yours. And if you look at it in the other way, if you decide that you want to buy a property and you want to do the maximum and you want to live in it, time flies. In 5 and 6 years' time, you will still have that bond. You will look at the amount you owe, and you'll only see that from 500,000, you've actually paid 20,000 in 6 years. So it's not taking you anywhere in terms of finances, in terms of your debt. So the best thing to do is your first property, buy half of it and just pay as much as you can. And that's actually going to help you with a lot. It's going to help you with the next bond that you take, because you have security. You say to the bank, listen here, I may not have the full money, but what you need to understand is that I have a house which I own. If anything happens, you can take that house. You can also look into businesses. You know, there's so many young people who say banks don't want to finance our businesses. Listen, you need to make sure that you have assets that they can attach if you don't pay back. You understand? So,
so that's why the bank didn't want to fund me, because I don't have assets.
Yeah, I'm very sorry, but I'm definitely sure in the next 6 years they're going to find your business. And
of course, Ntato, after this show, definitely tomorrow, starting tomorrow. Discipline is key. Yeah.
Yeah. Then also, we're looking into the practicality of it. You've bought your house and you are saying to me, Ntato, I have this house and I've made the mistake of maxing out what the bank said I can afford. What do I do? Because there's hope for everyone. As I mentioned before, just at minimum, anyone who has a bond, pay 10% extra at the very, very minimum, just so that you know that your bond moves easily from 20 to 15 years. That's one of the most effective things you can do. But if you have extra money, you just pay 20% extra, then it moves to around 13-year mark. Now there's progress. You pay 40%, you're going under 10 years. And people can afford such monies, but they just don't have the knowledge as to it, because people will say, the banks are forcing us to pay cars in 5 years and they're forcing us to pay houses in 20 years. No, they're not forcing you. There's actually a history behind it. There are accountants, there are people who've done the math. Look at it this way. For a bank, you buy a property of 500,000. It gets mortgaged. In 20 years' time, that property is going to be worth over R1 million. So whether that person takes 20 years or 30 years to pay it off, it doesn't matter, because the risk that you took to give this person finance for a property of R500,000, if they default in the future, as a bank, you're going to bargain more, because what you bought with 500,000 is now worth R1 million. But when it comes to a car, it depreciates. I mean, anyone who has tried to trade in their car, I don't even have to say anything. You understand? You buy that car, 300,000, As soon as you go out of the dealership, it's now worth 230,000. You drive it for a year, it's worth 0. You just have to own it. You have no choice, nothing. So that's the thought process behind it. Banks are not trying to, they are not the enemy of the people. You know, people start bashing banks to say banks are against us. No, if they were against you, they wouldn't have given you the loan in the first place.
Exactly. And then, so this goes to my next question. And last week we spoke in depth about credit score. And so what are the benefits of actually paying your mortgage off in 6 years? And how does this affect my credit score?
Yeah, the benefits are more selfish for you and your family than for any other thing. The examples that we've made here is a matter of your house being foreclosed if you don't pay up. Whether, you know, earlier this year, people were taking payment holidays. And the question that I asked was, you understand the payment holidays are 3 months, but what happens next? What about the 4th month, the 5th, the 6th? Because if you are not getting income now, you didn't get it before, you're still not getting it. Now I looked at the Red Bank, I won't mention them by name. They actually said they're looking into foreclosing and taking people's homes if they default, because they've run out of room to help people out. So once the banks start mentioning such things, you understand that it's going to be very sad losing your property that you've worked hard for. So if the benefit of it is that you pay it as soon as you can, after 6 years, you get your title deed. Whether you lose your job, whether you change, whatever it is that you do, you know that you have a property and you own it. You may lose your car, you may lose your job, you may lose your spouse, whatever it is that you're going to lose, but that house is yours. Your kids have a roof over their head. The last thing you want is to move back home. We understand that you can, but if you can put systems in place to ensure that you benefit, why not do it while you are still young? You know, when you are young, you have such a high income potential because you have energy. You can do side gigs, you can do consulting, you can go to your work. But as you grow older, then those opportunities start to diminish even, because even the opportunities to study and grants from the state, they tell you you must be youth, you must be 35 years old. So the things we take for granted while we are young, even our health, your health start to diminish as you grow older. So while you have the energy, you have the time, just do the best that you can, pay off that house, make sure that it's fine. But again, the financial aspect of it, you can't be paying 2.5 million rents after 20 years for a house worth 1 million. It's not fine. It can't be normal. As much as it has been normalized, and that's fine because that's the system, but we know better. We understand how things work. There are shows like these that educate us, and with the knowledge that we have, we must just do better. We owe it to our kids, at the very least.
That's very true. I think I want to go to a question quickly that we've got on Facebook from Palesa. So Palesa is asking, do I tell the bank right away that the bond is going to be for 6 years, or do I sign for 20 years? And I think you briefly touched on this.
Yeah, it's a very, very lovely question. Don't tell the bank anything, simply because of, even if a bond is for 20 years, we have a huge percentage of people that are defaulting on their loan, a loan that has to be paid over 20 years. So if you tell them it's for 6 years, basically what you are signing up is that you are committing to the bank that you will be paying 12,000 rands a month for a home loan of 500,000 rands. Are you going to have that 12,000 rands every month? Because that's the commitment that you have done. So what you need to do is keep quiet, take a loan for 20 years, pay extra into it, and let that money diminish the interest. Remember that with your interest, it gets compounded daily. So the more money there is inside your home loan, the more principal amount goes up, the more capital flows appreciate, then it means the money that you owe gets smaller and smaller, and the smaller amounts that you owe means that the interest that you need to pay, the interest amounts, they get diminished as time goes on. So don't tell them anything, keep quiet. Also, because of the day you don't have money to pay for that loan, you find out that the amounts that you've paid extra can actually pay for that house for the next 3 years. You're just going to lose your job, sit at home and enjoy yourself, because the bond will be taking into the extra money that you've paid. So it's a no-brainer, really. But there are people who actually prefer to tell the bank. And if that's your preference, make sure that financially you are fine.
Yeah, because with COVID, if I had told the bank that I'm going to pay it off in 6 years, it would have been to my detriment, you know. So I think that's really good advice. Don't tell them, just pay that little bit extra. And there's a question as well from Bong Sabakwena, which leads to my next question as well, is paying off quickly a good idea? And does it not expose you to tax?
Yeah, paying it off quickly is very good if it's your primary residence. So your primary residence is the house that you live in. For that, you have no reason to be paying 2.5 million for a 1 million house. So you pay it off as quickly as you can. Remember that with a primary residence, the only time you are going to be exposed to the tax question is when you sell the house. So now when you sell it, you need to pay taxes on the appreciation, on the income that you've received. But we also understand there are tax breaks for such. If it's your primary residence, I think it's up to over 2 million rands where you are exempt. So that's fine. Unless if you are paying off a house of 4 million rands, then there's that shortfall of 1.5 million rands that you're going to have to pay taxes in it. But remember, you only pay tax when you sell the house. When you own it, you are fine. But let's look into the approach of a property that you are renting out. Now, this is a different ball game altogether. If you are renting out the property, I repeat, never pay it off as soon as you can. You have nothing to gain out of it, simply because when you calculate your EBITDA and you do your SARS and you check your tax, your liabilities with taxes, once you have to calculate the taxes that you give to SARS, I'll give an example of if your income is 10,000 a month on the property, but you are paying a bond of 10,000 as well. And of that 10,000, 9,500 is interest. You will only be liable to pay for taxes on the 500 difference. You don't pay taxes on the interest that you pay the bank. So if you pay it off as soon as you can, you are going to find yourself in a position where that whole 10,000 is your income. And then it increases your tax liabilities from only that 500, and then now you have to pay taxes on the whole 10,000, and you may lose even up to half of that. So basically, you are working for the state. It's a process that was started after the Great Depression, just to make sure that money circulates and to ensure that people always go back to the banks to borrow more, because the more people borrow, the more the economy moves. So that's just the benefit that the state is giving to people. So if you are renting it out, don't pay it off. It's your primary residence, it's a liability, pay it off as soon as you can.
Yeah, thank you so much, Ntato. And this is one last question before we have to kind of wrap things up. This is from Nonkululeko. Is it wise, because you, Ntato, you call yourself a property practitioner, so this is a question for you. Is it wise to invest in a property company?
To invest, I need clarity on it. Do they mean that to invest in a company that owns properties? And if that's the case, is the company listed or not? Because there's a difference between a listed company that deals in properties or just a company that owns the physical property.
Okay, so Nonkululeko hasn't given us clarity, but I think let's go with the first one, to invest in a company that owns property.
Yeah, it's very wise, because basically, remember that the company is an entity on its own. So the government does recognize the company as its own person. So if I get sequestrated and I lose all my assets, all the houses that are registered under the company, they are ring-fenced. They are safe and nothing is going to happen to them because they're not owned by me. Properties that are owned by me have my ID number on them, and you can see, but this one is actually owned by the company in itself. It's a classical case of investments. I think majority of the properties that I own are in companies. I haven't yet transferred them to trusts, which is the ultimate goal. But for now, they're in companies simply because I'm going into a lot of businesses. I'm trying a lot of things. If all else fails, at least I shouldn't lose what I've worked so hard for. So just try and separate the two. But it's difficult if you don't have cash. Remember, with the bank, when they give me a bond, they give a bond to Ntato with the ID number of Ntato. You can't register it under the business. If you do that, then you are going to have a business that is already existing, a company that has income statements, a company that has been making money for 3 years, and you have all those income statements that have been checked by chartered accountants. And it's a nightmare, basically.
Yeah, so rather do, keep it registered to yourself. Is that what you're saying?
I'm saying if you need a bond, you have no choice for the first few properties to register it under your name. But as they make money, make sure that you raise capital. When you raise capital, buy those properties cash, register them under a company, and just keep quiet.
Okay, perfect. We've gotten some really good questions, which we don't really have time to go in depth for. There's some really good questions here. But I think just in conclusion, Nthato, this is my final question, my closing question. What happens when I'm done paying off my mortgage? What then?
Definitely. Lovely question. With that, you need, first of all, you must tell the bank that I've paid it off. They will actually call you and say, you're about to pay off your mortgage, would like to give you off money to fix your house. That's the classical example that they give you. When I give you some, just so that you don't close it off. But at the time, you know that it's coming. So you said, no, I'm fine. But you must call them and give them a 3-month notice, 90-day notice. If you don't, and you just abruptly close your bond, then you are going to pay 3 times your monthly installment for your bond in penalties. So that's what you need to tell them if you decide to close the bond. There are 2 approaches to it. You either close the bond or you keep it open. I prefer keeping it open simply because imagine if I've paid off a house of 1 million rands and I have 1 million rands sitting in any account of mine and I didn't close that bond. I'm only paying fees of 60 rands monthly to have that liquidity at my disposal. What that means is if I have a property that I want to build in the homelands where people are not getting bonds, I can take 200,000 and go build and come back and return it. If anything happens, I have businesses that I want to, you have liquidity, you have access to cash, but that needs discipline because someone may take the money and just eat it. And then after eating it, you are back to square one. So just don't close it, keep it open and just make sure that you have the liquidity to then invest in properties in the name of a company because you'll be paying them cash from the first property that you paid off.
Exactly. So again, I think what you've preached so often tonight is just discipline. So don't close off the mortgage and just discipline yourself on how to just leave the money there and invest in other things. But thank you so much, Nthato, for joining us this evening. And since you quoted Einstein earlier, in the spirit of Einstein, I read something earlier which spoke about, I think it's an Einstein quote, where he says, if you can't explain it to a 6-year-old, it means you don't understand enough about it. And you're so well knowledgeable on the topic. I mean, I'd love to have you back on the show because there's so many other things we can talk about. And if you see, maybe later, if you have time, the questions on Facebook were so, and it's really good questions, but we don't have time for all of that. So thank you again to our guests who asked those questions, who commented. Thank you so much for joining us. Nthato, do you have any last words that you'd like to leave us with?
Thank you so much for having me. I'd like to say to South Africans, ensure that you equip yourselves with education. You are not forced to pay off a home loan in 20 years' time. If you're not doing it for yourself, do it for your kids. Pay it off and own it.
Yeah, leave a legacy, like you say. So guys, let's leave a legacy and please join us again next week at the First Time Home Buyer Show. Thank you so much to everyone.
Hi, I'm Clifton Smithers. I live in Belito, where my partners and I run a business called Union 3. As a family, we chose to move here about 6 years ago. What attracted us to the area was the safe and relaxed lifestyle of the North Coast. We're surrounded by so much natural beauty, and we love that it's so casual. It's just not as intense as a busy city. In fact, that's one of the main reasons there's so many people moving into the area. There's some amazing lifestyle estates out here. We've got Zimbali, Brettonwood Estate, and Zimbiti, to name a few. The Belito Lifestyle Centre caters to everyone's needs. There's also some smaller commercial centres like Tiffany's and Salt Rock. There's some excellent restaurants to choose from, and there's a really wide variety of activities on offer. From mountain biking out on the trails to surfing at any one of the beaches, there really is something for everyone. This quiet little town really comes alive over the weekend. The live concerts in the farmers market at the Lychee Orchard is very popular. With the new international airport just 15 minutes down the road and the unmatched lifestyle that this place offers, it's no wonder that the North Coast is the fastest growing town in South Africa. My family and I absolutely love it here, and this is our neighborhood.